All right, welcome everyone. Thanks for tuning into this episode of the Hawaii Retirement Show. Today we're talking about investor biases. Okay, and this is kind of an important topic. Even if you think yourself as a passive investor, you can still fall prey to a lot of this stuff. And the way I break it down, I came across some chartered financial analysts, some CFA study material, and I kind of followed their format for how they approach this and break it down. And the way they do that, they break it down into two different categories. One is cognitive errors, and the other is emotional biases. Okay, so cognitive errors, pretty straightforward, right? Thinking errors, how you process information, poor statistical understanding, illogical reasoning, memory faults, stuff like that. And then you have the emotional biases, which is driven by feelings, impulses, and intuition. Okay, pretty straightforward. Cognitive errors and emotional biases. But both of these, a lot of us like to think that we wouldn't fall prey to that. We're realists, we're pretty objective in our thinking. But even the best of us fall prey to some of this stuff now and again. And it's actually so common that it's almost expected in investing and financial analysis. We almost expect a lot of these cognitive errors and emotional biases, and we'll get into what those are, to happen and affect the markets. So a couple points here. Biases can often be a mix of both, right? Just because we have cognitive errors and emotional biases, some market anomalies or some things going on in the market can be due to a combination of multiple biases and the interplay amongst them, right? And then we have, I guess for this, it's just kind of like a public service announcement in that investing is not just about the numbers, right? It's psychology. There's a lot of emotion. There's a lot of speculation that goes into investing. And it's not just about analytics, right? Analytics play a huge part and maybe should be weighted much more heavier than they actually are. But it is a behavioral, psychological thing, investing. Last point on that is discipline and emotional control are key to long-term success, right? So that's why I kind of wanted to do this is if we can understand our biases, if we can understand these things, then we can at least hopefully catch them some points down the road, put them in check. And the more we're aware of this, or the more you have systems in place to avoid falling prey to these, the greater your potential long-term success and you sticking to a plan. Okay, so with that said, let's start with cognitive errors, right? There's two categories. Like I said, we're breaking this up into cognitive errors and behavioral biases. Now, within cognitive errors, there's two categories. There's the belief perseverance bias and the information processing bias. Okay, belief perseverance, that's our tendency to stick with original beliefs even when faced with new contradicting information. Okay, which we're all familiar with this. We get dug in on a side and we try to make the data and the facts fit our opinion because we don't want to be wrong, right? We want to tell a story to ourselves of why, how this fits into our already given beliefs. The other part is information processing, and this is just about interpreting the data, probability estimation, mistakes with judgment, stuff like that. Okay, so let's start with these belief perseverance biases, and I'll run down a few of them here. We have conservatism bias, which is slow to update beliefs with new information. You underreact to the market, can lead to outdated investment decisions, right? Conservatism. I don't know why I have a hard time saying that, but conservatism means, you're just slow to react. You're slow to get into it. You're kind of cautious, overly cautious, right? And that's a bias that a lot of us might have. Next one, confirmation bias. Seeks info that confirms existing views, ignores and dismisses contradictory evidence, reinforces overconfidence in one's analysis. So again, this goes back to just the whole broader category we're going over, belief perseverance. We're looking for confirmation that we are right, that we're accurate in our judgment, that we're looking at things correctly, and that can lead to a whole slew of issues there. Next one, representative bias. So we assume a recent patterns will continue. Stereotypes investments without full data. So stereotypes, a lot of assumptions. You ignore probabilities. You draw conclusions from too little data, right? There's not enough data to make a informed decision, but you have this representative bias, and you're kind of oftentimes you're chasing recent winners, and so it has this momentum effect. And again, you just try to make the data match whatever you want it to believe, right? Whether that's consciously or unconsciously. Okay, a couple more on the belief perseverance biases. We have illusion of control. We overestimate ability to influence outcomes, right? We think we have more control than we do. We believe we can beat the market, right? That's an illusion of control. I'm smarter than what's going on here. And this is super common in active traders and market timers. Now, I've done an episode on this before, but I just want to stress how difficult it is to beat the market as an active investor, especially when you're not a high net worth or an institutional investor who has access to maybe, different opportunities. But as just a regular retail investor, really hard. Impossible? No. Uh, the academic data from what I've looked over, and feel free to comment and prove me wrong here, especially over the long haul, it's nearly impossible, right? So let's say somebody is an active trader and they beat the market for, let's say, 2 years in a row and they're just killing it. You got to wait and see, well, how do they perform over 5 years? Did they have 2 good years? Did they get a little luck involved? Did they catch a little rising tide? How does that look after 5 years? And then when you span it out even further, how does that look after 10 years? Very few, if almost none, of active traders can outperform the overall market and the benchmarks over an extended period of time. And it's not that there's not brilliant people trying to do it, and it's not that there's not potential to do it. There is. It's just extremely difficult because there's so many variables, and just so much going on. Nobody knows what the market is doing, and if they tell you they do, I would question them. Okay, last one, hindsight bias. Believes past events were predictable. I knew it all along, right? And you can see this with the 2008 financial crisis. In retrospect, when somebody explains it, it seems so obvious. Psh, how did we not see this coming, right? But the problem is, at the time, there was only, a handful of people who actually saw this for what it was. So it's easy to Monday morning quarterback, right? To go back after the game and say, oh, it's so obvious. Yeah, no, I just got to do this next time. Not that obvious, right? There's biases there. Okay, so let's go from the cognitive errors that are belief perseverance to now we're talking about cognitive errors on information processing, okay, and the biases there. Uh, Information processing is a lot more analytical, right? So we have anchoring and adjustment biases. So you're fixates on initial value, right? You're fixated on kind of what you believe the initial value is, and you don't want to sway too far from that. That's your anchoring. You fail to adjust, you just anchor in. And it can cause investors to be slow to react, right? Post earnings drift, they would call it, right? So anchoring and adjustment, you're slow to react. You're kind of anchored in on a fixed point. There's the mental accounting bias. It treats money differently based on the source and purpose, right? And so you can see this with, let's say you're in Vegas, right, and you win some money. Okay, how you treated the winnings there. Now you say, well, this is house money. I don't care if I lose it. It's different money. When in reality, if you look at it from just a pure uh, black and white perspective, this is just money. It's all money. $1 here is not different than $1 there. But the way you bucket it, your mental accounting of what this is. Oh, this isn't my salary. This is a bonus, right? This is overtime money. So I'm going to use that overtime money for something else, and that's fine. But just understand that you're framing the same thing quantitatively. It's still a dollar, whether it's your salary or your overtime or your bonus, or whether it's winnings from gambling or what you're willing to spend in Las Vegas, right? So there's that mental accounting biases. Okay, you have framing biases, which is decisions depend on how info is presented. Reacts differently to gains and losses. So how you frame things, you might take a loss, but you frame it as, well, I kind of knew it wasn't going to be so successful. Or you take a big win, you say, oh, that was unexpected, or I knew that was going to happen all along. So how you frame things definitely impacts how you invest. Last one, availability biases relies on easily recalled and recent information. Overestimates impact of vivid or dramatic events, right? Whatever we can kind of immediately recall is what we kind of use to draw our arguments or perspectives when it comes to investing, which just makes a lot of sense, right? Okay, so that kind of wraps it up for the cognitive errors there, the analytical, the thinking errors. Now we'll go into the emotional biases. And this is pretty straightforward, right? We all know we have emotional biases. As much as we like to think we're fully in control and command, none of us are Sam Harris out there, just meditating and completely in control of our impulses at all times, right? So let's start with loss aversion biases. I'm sure a lot of you have heard with this, where losses feel more painful than equivalent gains. And that's why a lot of times you see nobody really cares or listens to the market media when things are going pretty good. They just, yeah, yeah, things are going good. I'm happy. I'm happy. As soon as things start to pull back or retract, everybody kind of clenches up and starts to listen. And they're, because those losses, right? You're much more sensitive to losses, which is, pretty obvious stuff. A lot of people know we're risk averse creatures, right? We want as much gain with as little risk as possible by nature. That's how we are. Next one is overconfidence biases. So we overestimate our personal skills, knowledge, and control. And it can lead to excessive trading, risk taking, and volatility. There's subtypes of this where they talk about illusion of knowledge, self attribution, prediction overconfidence, certainty overconfidence, and I think we all are very susceptible to this. I know I am. I'm sure a lot of us, a lot of you listening, if you take a deep look inside, I think you could probably say the same. And I like to talk about that study where they survey so many people about their driving capabilities. And what they find is 90%, something like, I'm making up these numbers, but the moral of the story is true, is something like 90% of people believe that they're great drivers, right? Which is statistically impossible. Most of us are average. Especially if you've taken a statistics class, the bell curve. Most of us fall in that just middle of the bell. We're not brilliant people, and we're not, necessarily, you know, dumb people, right? We're just in the middle there. A lot of us are average. A lot of us think we're exceptional, and that's great. I'm not discounting that. I'm not saying you need to change how you approach things because that can lead to a lot of great things. But just understand, most of us are very, very average. And I think that's good to keep in mind when you're looking at investing and trading. Okay, so emotional biases, we have four more here. We have self-control bias. We have which leads to impulsive, inconsistent investing. You have a hard time, with your self-control. You're impulsive. Status quo, where we prefer things to just be, a slow, steady rise, and we just want to maintain where things are, and that can lead to, delays in how we approach things. There's the endowment bias where we overvalue owned assets. So because we own it already, we're reluctant to sell it maybe or trade it because we have it already. That's called the endowment bias. We have regret aversion, where we avoid decisions that might lead to regret. This is kind of this similar. I think this lumps into the loss aversion, and then the herding behavior. Right? We all know about this. And even the most independent leaders can still fall prey to this, right? We're a community, we're a society. We kind of move together. I know we're very divisive right now politically and all that kind of stuff, but take that out of it. We like to work in groups. We like to be in groups. We like to work together, and we fall prey to this herding mentality from time to time. Okay, so let's wrap it up here. Behavioral biases, they drive market anomalies, right? Cognitive and emotional biases. Just be aware of them. Be objective. Have a plan, right? This is how you mitigate these cognitive emotional biases. You have a plan. You have systems in place, right? Strategies like dollar cost averaging. That reduces impulsive decisions. You're just investing every month or every quarter or every whatever it is, every year, regardless of markets ups and downs and what's going on, right? That's a system to alleviate all of the subjective biases that come in there. The other thing is just be aware, just do your due diligence, look inside, self-reflection, and it can't hurt to seek objective advice from financial professionals. You see an advisor, you don't necessarily have to work with them forever. You check in. Am I kind of on track here? Am I looking at this correctly? And to get that second opinion can be huge, right? Even if you are doing everything correct, at least you get that kind of reassurance, right? And I think that counts for a lot. Closing thoughts here. Investing, again, this is what I said at the start. It's not just about numbers, but psychology, right? It's about behavior, just as much as it is about the analytics. And lastly, developing discipline and emotional control is key to long-term success. If you're looking long-term, then you got to have these systems in place, the discipline, the emotional control, set it and forget it. And a lot of you are really good at this. But even in a passive investing strategy, you're still going to fall prey to when the market goes down a lot. You might think, "Oh, I'm gonna pull out. I need to. I'm worried. I'm heading towards retirement. Should I change things?" You should have a plan in place where you're never going to have to. I mean, you got to be reactive to some extent, but your plan should already outline what happens in certain situations where it's like, okay, we knew something like this was coming, right? And so we've planned for it. So now it's just reminding ourselves that we knew this was coming and this is how we're going to handle it and get through it. So yeah, just plan ahead. I thought this was an interesting topic, just the investor biases. I think we all fall prey to them as much as we want to believe that we're different and we're special. Most of us are not, and that's okay. And it's okay to still have that belief that we are, but especially when it comes to investing, I always say, nobody knows what's going to happen in the future. And even, when you base decisions off historical context and how things have always been, nothing says that's how things will continue. So just keep it all in mind, get a plan, stick to it. I think that wraps it up here. If there's anything in the future you'd like us to talk about on the show, email it over to aloha@hawaiiretirementshow.com, and we'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Katita and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by Toba Financial. For Jason Katita, investment advisory services are offered through Toba Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.